Good afternoon, and I'd like to welcome you to our webinar this afternoon, Creating Income for Retirement, the Upside of Protecting Your Downside. I was just sitting here thinking what a difference a week makes. Hope you and yours weathered the storm as well. 77 degrees this week, and what we would have given for another 10 or 15 degrees of this last week. But anyway, let's, to make it best use of everyone's time, let's get right to this. Again, thank you for joining us. Who are we? We're the Price Group. You probably figured that much out. Family owned and operated, 40 years of experience between our team. We are a fiduciary. We think that's very important. We can talk a little bit about that as we go forward. And our expertise and the niche that we serve is retirement. So if you're 5 years from retirement or are retired, we're hoping that you'll stay with us. We're going to try to make this a good use of your 45, 55 minutes here. We are a registered advisory firm. That's very important. It's different and allows us to operate as a fiduciary. Our firm is Stewart Partners, employee owned, $17+ billion in assets. And we use Raymond James as our back office and our custodian. They are a vendor of ours. We are not Raymond James. We work for the client, hence, again, Stewart Partners being a registered investment advisory firm. People ask, well, you know, what about you guys? Do you really know what you're talking about? We have the educational background. We have the team in place, and we've been very fortunate to receive some accolades from Barron's, Forbes, Financial Times, and very appreciative of that. Those are truly team awards. And so again, this is all we do. If you have heart issues, you don't want to see a doctor that does hearts just on Tuesday. You want someone that does hearts every day of the week. So today's agenda, we're going to do a couple brain teasers, take an overview of the markets, talk to you about the 5 risks of retirement, how producing income mitigates the risk of retirement, and tell you a little bit of our approach, which we think makes sense, whether you would use our services or not, how to financially live well in retirement.
And so there's probably a handful of different reasons that you might have attended this webinar. Not sure how long your money might last through a current or future retirement. You want to avoid making mistakes. You might be someone that's looking to better generate steady income in retirement. Whatever it might be, the list could be long, but we can say this confidently. All of us, Randy and I included, we're looking for comfort, confidence, and clarity as it pertains to our future retirement. And so with that being said, that is our goal for today. We want to hopefully provide a little more comfort, confidence, clarity, maybe on where you are or more importantly, where you will be going. So let's warm up the brain here, get us nice and loose. What was the annualized total return for the S&P 500, a collection of the 500 largest stocks here in the U.S. for the decade of the 1930s. And given the fact that we're virtual, while in person, we like to ask for some guess. Let the cat out of the bag. It's actually A, 0.0%, which is rather interesting from a standpoint of a lot of investors over the past, call it 9 months or so, have gotten really used to the stock market going straight up. And this is a great illustration that stocks can go up, stocks can go down, and ultimately stocks can go sideways for quite a long period of time. So let's look, just kind of review where we are in the market. This is one of Randy's and my favorite slides, kind of a busy chart, but let me give us our bearings here. We are looking from 1900 through the end of 2020. Green periods are good, bear periods are bad, red periods are bad, bear markets. I want to draw your attention to this one period of time here from 1972 to 1981. And you can see, like I just mentioned, stocks are up, stocks are down. Stocks actually went sideways for a considerable period of time. One of the most often asked questions we get is this bull market over? And our short answer would be no, we don't think so. Bull markets, if you look back at history using a chart like this, typically run 15 to 20 years in length, and you can see here we're about 12 years, round numbers, into this bull market. So we do think we have a few years left to run.
So when you are an investor, especially if you're an investor toward retirement, you're thinking income. How do I get income? And maybe that's from some CDs, maybe that's from some stocks. Obviously, it's very tough to have any money in the bank and get income from that. But we see the U.S. Treasury bond yields hovering around 70-year lows. Now, a little bit of history. Almost a year ago, COVID March 2020, the 10-year U.S. government bond hit a low of 0.36%. Now, it's made a big move. Today, it's finished at 1.36%. And so statistically, that's a huge move up, but still very low from a historical standard across the world. Some countries have negative yields, sort of hard to get our mind around that. But we've seen a lot of money flow into bonds and bond funds for the past few years. Now, what many investors do not realize as we look at the next chart there is that bonds are not guaranteed to have a positive rate of return, and they're affected by inflation. So let's look at three periods of time here, a period 1920 to 1940. And you see here that the Treasury notes, the Treasury bills did very well. By the way, these are real rates of return. So you subtract the inflation rate from the actual return that you've made. Then we get into the Second World War, 1941 through 1981. And wow, you see a negative rate of return for the Treasury notes and the Treasury bills. What that means, after subtracting inflation, you backed up. Bonds were not a good place to be. And then you go on to 1982 to 2009, and you see another positive time period for Treasury notes and Treasury bills. So what are we pointing out here? We're pointing out that we've got three periods here. Two have worked well to be a bond investor. One has not. We can tell you exactly what's happened historically, but most importantly for you, most importantly for all our clients, is what does the bond market look like going forward? And especially if you're retiring, it becomes even especially critical for that. So it is indeed an interesting dilemma. We talk about the duel of competing interest rate factors. We said when we put this webinar together, actually a couple of weeks ago, the 10-year was below 1%. We thought we were sort of out on the edge of the limb, saying the 10-year might get to 1.50, and now it's 1.36. So interest rates have moved in the direction we predicted. So there's some factors that support higher interest rates. The biggest thing is the vaccine and sort of the recovery of the economy. But you've got some factors that support lower interest rates by the end of the year. Demographics, the Federal Reserve keeping short-term rates down, and a lot of foreign people are buying U.S. government bonds, which is helping the U.S. to continue to issue bonds at very low interest rates, historically speaking. So again, we'll see what happens, but we think this is very important for sort of a background of where we are, and more importantly, where you are as an investor now and going forward.
Another one of the main questions we get a lot from clients: high debt levels, will this slow economic growth? And the short answer is yes. The statistic is economic growth falls by about 50% when public debt exceeds 90% of the GDP. And so this is a look back at the federal debt as a percentage of the GDP, the gross domestic product. And you can see here just as of late last year, we did exceed that 90% threshold. Actually had a conversation this morning with a client, and she said it well. She said, we're just stealing, was her words, from future generations. So my kids, my future grandkids, taking from them to have more growth now. Right now, the market, it doesn't really look to be worried about the debt levels, but that doesn't mean down the road they're not going to be. This is one of the things that Randy and I would find most alarming. If you look back to World War II, which you can't see on this chart here, there's three ways to get yourself out of debt from a country perspective. And after World War II, you saw all three of these strategies implemented. Number one, you can tax your way out of it. Number two, you can grow your way out of it. Number three, you can inflate your way out of it. And there's not necessarily a perfect answer of picking one, but it's probably at some point a combination of the three to slowly reduce some of this debt burden that our country has taken on. Keeping politics out of your portfolio, here's a look back to President Truman and the stock market performance with every president. Big picture, we don't think that one president in office can kill a bull market. And while political views might be different, we think it's very important to put that political affiliation to the side and focus on long-term investing.
So with that, let's talk about the economy going forward. We think of this as a triathlon. We think as Matt has said, that the bull market is not over, that the U.S. economic recovery will continue to move higher as more people go back to work, as more products and services are available. The vaccine seems to be working. The COVID numbers seem to be coming lower. The market has already anticipated that, so we think that the stock market for the year is probably going to be up 6 to 8%. We hope we're wrong and it's up double digits, but the stock market always looks ahead, always trying to anticipate what's going on. And there on the right-hand side, talk about our daily activities and lives return more to whatever normal means, more steady, and if you will, less supply shortages and so on and so forth. So again, the triathlon of the U.S. economy for 2021.
So let's jump in and look at what we think are the top 5 risks of retirement for you guys that are approaching retirement or already in retirement. The first being longevity. There is, for a couple, this is based off a couple that's 65 years old, there's a 63% chance that one of you would reach age 90. And actually, there's a 1 in 20 chance, 1 in 20 boomers will actually reach age 100. So last year was one of the first years where the life expectancy actually backed up a little bit, but we would think that it continues to creep higher in the following years here. But longevity being we think one of the biggest risks for retirement.
So your money's got to last, and if your money's got to last because you're living longer, you have to be even more sensitive to inflation. How about that on the right-hand side, being able to full service for 54 cents for regular, and you see now gas prices are back to $2, which is still low by how high they've been. Let's talk about inflation. Inflation can be looked at as a hidden tax. How long does it take the cost of living to double? Well, you can see historically we've had about a 3.3% rate of inflation. The Federal Reserve, our central bank here in the United States, has said they're aiming to produce some inflation in the 2% range. That's looking back from 1913 to today's period, 2020 is latest information. But divide the rate of inflation into 72. It's called the rule of 72, and it will tell you how long it takes for the cost of living to double. So if you're retiring at 60 and you have 3% inflation, it's going to double the cost of living every 24 years. So by the time you get to 84, the cost of living will double. But let's run the numbers higher back when some people may remember when interest rates and rate of inflation were much higher. You get to a 6% inflation, that means your cost of living is going to double every 12 years. 6 into 72 is 12. So if you're retiring at 60, your cost of living doubles at 72. By 72, doubles again at 84. So you can see a small change in the rate of inflation can have a dramatic impact. And so when you plan for income during retirement, you're not so much planning for just income, you're planning for real income. Real income means income adjusted for inflation. So if a movie ticket costs $10 today and costs $20 tomorrow, you want to be able to afford that movie ticket that costs more, the gallon of gasoline or the automobile. Probably the best thing to look back on inflation. Maybe we have some stamp collectors or some people that have saved letters from loved ones, but you look back on how the price of a postage stamp has gone higher and higher and higher. My wife found some stamps buried somewhere, and they were like 32-cent stamps. And, it almost works now to put 2 of them on there to just get the price of a first-class letter today. So inflation, big deal. Yes, it is part of the planning process. Risk number 3, the market performance. If you have $100,000, get 7% average return, inflation of 3%, and you have no withdrawals, or look on the left side, the sequence of returns has no effect when you're in the accumulation phase. So if you're working, you're putting into your 401k, matters not if you start off with a negative 15% and then have a positive 29%, or you get 29 and then 7s in the middle and a negative 15 at the end. You're putting in money, and that works well. But very important, probably one of the most important things that you'll learn from what we talk about today is when you start taking withdrawals from your retirement assets, IRA distributions, taking income from the mutual fund, whatever, when you start to do that, the sequence of returns has a dramatic impact on that in the distribution phase. So again, in our example, much better to get a high positive rate of return, the 29% there in our example, year 1 of retirement, as opposed to starting retirement with the negative 29%. Can make a huge difference. And so from a standpoint of that, you need to have a process, you need to have a system in place to react to things you cannot control. And that's why we put risk number 3, market performance, as a very important factor to look out for during the planning.
And what this means to you is we're going to talk about our Live Well plan. It's what we put together. Most all clients have it, and we're happy to put it together for you on a complimentary basis. But to plan for this market performance, what we're doing, our Monte Carlo simulation behind the scenes, we're actually showing you retiring 1,000 different times. And so using a law of large numbers to take this into account so we don't have to actually worry about this. We're planning for poor performance. Under promise, over perform is the old adage, and we really want to do that when planning for retirement. Still here on the 3rd retirement risk, market performance, but it's a slightly different market risk. I want to draw your attention here to what we're looking at. Let's say we have a 20% loss in the portfolio, and you are taking out a 4% withdrawal rate of that portfolio. You might kind of quickly say, well, 20% down, I need 20% to get back to break even. And I'd say not so fast, my friend. With that 4% withdrawal rate and assuming 3% inflation, you need a 36% increase in the portfolio's value just to get back to break even. And so we like to think of it as kind of a bathtub, water coming in, water coming out. This is really why income generation in retirement is so important, and we'll talk about this in a minute, but managing downside risk, you can make a fairly compelling argument. It's not as important while you're accumulating, but in retirement, having an investment process that is predicated upon protecting on the downside is very, very, did I say very important when compared to accumulating money. So we think it's something that you should seriously consider, and a big component of that is producing income in retirement. Moving on to the fourth risk here, investing without a process. A little bit of a busy slide. Let me kind of paint the picture of what we're looking at. This dark green line here is the S&P 500, and the lighter shaded green areas are when money has been put into the stock market. The shaded areas down here are when money has been taken out. And what you can see here is the average mutual fund here, dating back from 1990 through the end of 2013, and this would be mutual funds across the board. The average investor bought high and sold low. And so Warren Buffett has the famous saying to the opposite. He's looking to, he says investing in stocks is easy, just buy low, sell high. And so with that being said, the reason for this, and this isn't picking on any one particular mutual fund or investor, this is the law of large numbers, emotions really matter. And with that being said, the reason that people bought high and sold low is they didn't have a process in place. And so whether it's professional help with someone like us or you doing it yourself, you need to have a process, and you need to have a real gut check on, can you stick to that process, not if there are down periods in the market, but when there are down periods in the market.
Yeah, it sort of reminds me of you go to the store and they have something on sale, and you say, well, hey, if they're on sale, let's buy 2 of them: toothpaste, toilet paper, so on and so forth. But when stocks go on sale, typically it scares people, and as Matt said, people will sell out. So again, the investing process. So continuing on this, here's an interesting couple of stories, statistic and a story here. So you see the 20-year annualized rate of returns for real estate investment trust, REITs there, high yield corporate bonds, junk bonds, what some people would call, the S&P 500, bonds in general, your average home, inflation, and then right there, the red was the rate of return using data from all these mutual fund companies that the average investor had made. And again, this chart gets updated on a regular basis, and it doesn't vary very much at all. But what it's saying is that it's not timing, but it's time in the market. And so many people will get scared and decide to pull out of the market at a particular point in time, and therefore hurt their long-term rate of return. So how you do as an investor during retirement obviously will dramatically influence your standard of living during retirement. And the problem with having money issues during retirement is you don't get to 81 one day and wake up and go, oh my gracious, I may have an income problem and run out of money. You're worried at 65, you're worried at 66, you're worried about taking the trip, or you're worried when the market goes down. You're concerned, and again, without that clarity, there is no confidence, and without that confidence, there is no comfort. So we talk about the 3 C's: comfort, clarity, and confidence. Now, interesting story here. Many of you will recognize the name, maybe the face there, Peter Lynch. He was the manager of, at one time, the largest mutual fund in the universe that we know about, the world. And so he was doing an interview one time, and a financial reporter asked him a question. They thought it was a really good question. He said, Mr. Lynch, could I ask you a question? Yes, sir, you could. What is the biggest regret that you have when you were manager of this huge mutual fund? Again, wildly successful, made a lot of money for investors over time. And I think the reporter was probably thinking, well, I should have bought XYZ stock, or I didn't double down when, this happened, or, I missed the rally in the oil stocks or the internet stocks or whatever. But without even missing a beat, very quickly he answered, oh, absolutely. He said, the average investor in my mutual fund came nowhere near the average return of my mutual fund. And the reporter was a little bit confused. Could you explain that? He said, sure, be happy to. He said people put money in at the wrong times. When the fund was doing well, it'd come off a great year. People would say, hey, looks like this fund is doing really well. I'm going to put some money in it. And so they would buy high. And then at the times, and there's always going to be times, on average, the market goes down 10% about once every year, 20% on average about once every 3 years. It's always something happens. He said, and people took their money out at the wrong time. So they bought high, they sold low. They didn't make as much money as my mutual fund did. He said, that's a shame. He said, I wish I had done a better job. He said, I wish Fidelity had done a better job of educating investors. But again, it comes down to fear and greed are the two emotions that typically drive the market. So anyway, retirement risk number 5 is healthcare. The average couple will spend almost $300,000 to cover healthcare expenses in retirement, and then there's some unexpected costs from illness, injury, or perhaps nursing home or whatever. 46% of the people said they would need less than 100. Obviously, that's a big miss. 33% admitted to not having any idea. So what we are talking and recommending, and we think it is very good advice, even if we do say so ourselves, but look before you leap. Make sure you plan for your retirement. A lot of people do a lot of planning before they go on vacation. I'm going to take this flight. We're going here. We're going to eat this restaurant. It was rated well. This ice cream shop is special. I know a family that went on a overseas trip, and they had a 14 or 15 page document. The person that had done that had ice cream at lunch and ice cream at dinner, gelato actually. And anyway, but spend as much time planning your retirement as or more as you do planning some of the other things of your life. People will say, well, I really don't know that much about it. How do you face these uncertainties? Well, we think you've got to start with some certainty, and the first step here is to create that retirement roadmap.
Yeah, so like Randy said, we would encourage you to look before you leap. We call this our Live Well plan. We're trying to answer the following questions you can see on the screen here. How much can you spend in retirement? How long will your money last? What rate of return do we need? Most importantly, how much income do you need to produce? And how to invest the portfolio in retirement. This is a great baseline, a great cornerstone for everyone when they are approaching retirement. We think the best time to start something like this is within 5 years of retirement. The closer you are to 5 years, the more you can do to implement a few changes, recommendations we might have after studying your personal situation. And like we mentioned earlier, it's complimentary, no strings attached. Our promise is when helping walk you through this, it's you're going to leave a little more educated than when you started the conversation. We're also going to stress test your portfolio. We mentioned the Monte Carlo simulation, and two pieces to this. One of them we can help a lot with. The other we can ask a few open-ended questions. But can your retirement plan recover from a 40% downturn in the stock market? Last year we saw just about round numbers 30% downturn in the market. 2008 was a year down about round numbers 39% for the S&P. The first question though there listed is a little more personal reflection on your own situation. Can you emotionally handle that? And there's not a right or wrong answer to the question, but everyone is different. And so our goal is we want to take the least amount of risk possible to get you from here to there. And for different people, that's a different number, and that's fine, but we need to just look ourselves in the mirror and be honest and know what we are willing to invest in, knowing that with stocks, the ride could be a little more bumpy than with fixed income, CDs, or other alternatives. So love this quote by Benjamin Graham: the essence of investment management is the management of risk, not the management of returns. And we think that's actually more important in retirement than leading up to retirement. Third step, maximizing Social Security benefits. There's actually over 80 different ways for a married couple to file for Social Security. Everyone on this call probably remembers you used to get a Social Security statement. They stopped doing that to save money a few years back, but you can get that online now. A part of the Live Well plan is figuring out what the best recipe for Social Security is on when to take those benefits. We'll joke and say, tell us how long you're going to live, and we'll tell you exactly when to take those benefits. But it's a big part of really everyone's Live Well plan is when to file for those benefits. And some of the stuff can get a little bit complicated, especially if there is one spouse that's been in the teacher has been a teacher in the state of Texas at a public school for any period of time.
So step 4, it's getting near tax time. 1099s are starting to come in the mail, but our Live Well plan looks to promote income tax efficiencies. If you're over 70 and a half and you're making some contributions, charitable contributions to 501c3 organization, your church, any type of alma mater, that sort of thing, you can take part of the money that you would have to take out each year from your required minimum distribution and have the person that's holding your IRA send that money directly to a charity. It's called a qualified charitable distribution, or QCD. Great idea, because you basically get a back-end deduction on it, where with the income tax brackets where they are, the standard deduction, it's very hard with a limitation on property taxes to get enough to get over that amount. And anyway, that's a good idea. We have some clients that will have appreciated shares of stock. You've bought a stock at $10, the stock's worth $40. Give those shares of stock away and the tax disappears. The charity doesn't have to pay the tax. You say, well, hey, I still like the tax. Well, take the cash and rebuy those shares, and therefore you have a higher cost basis. And if you would have to sell them, need to sell them, there'd be less of a tax impact. And the age-old consider bunching deductions to be able to itemize, itemize every other year. So we work closely with the client's CPA, et cetera, to make sure that we are being income tax efficient. Cash flow planning. Wow, busy chart here, but a very helpful chart. This chart shows a number of different distribution rates from a portfolio that started about 1973. And for a 65-year-old couple, there's a 94% chance that at least one spouse will need income at age 80. So anyway, that's a number to work with. Rule of thumb, you'll need 70 to 80% of your salary prior to retirement. And we can see there that this person who retired and took 4% a year, they actually gained. Their nest egg grew during retirement, and voila, they had plenty of money. Now, person that said 5%, took out 5%, they'd run out of money at age 88, and maybe they both only lived 87. And they said, fine, we wish the check to the undertaker to pass. We hear people sometimes say, well, what's the difference between 4% and 5%? It's just 1%, but statistically, it's a 25% differential and can have a huge impact on your retirement. You can see there 5%, 6%, 7%, they all crashed and burned. Now, as we talk about that, as we're looking, as we go to the next slide, today, we've talked about interest rates being very low. The money at the banks earning virtually zero. The Federal Reserve keeping short-term rates effectively at zero. Long-term rates much higher than they were this time last year, but still the 10-year U.S. government bond is 1.36%. Would you invest for 10 years at 1.36%? You say, well, no, Matt, Randy, can't do it. Got to have more income. So we think that as you model your portfolios, as we do our Live Well plan, we talk to clients, we ask them the question. Nobody knows the answer. Could 3% be the new 4%? And that is, there were a number of studies that have been done over the years, and people sort of said, hey, no matter what the market does, you can take 4% out of your portfolio, ride the ups and downs, keep a solid investment in stocks, but invest the remainder that you don't have in stocks in bonds, and you're going to be okay. Statistically, mathematically, historically, it's worked every single time. Well, let's talk about that. Again, interest rates are much lower than they were. And if you are having 50 to 60% of your non-stock assets in bonds, then those numbers are going to have to change. So the market performance during retirement will affect what your sustainable withdrawal rate is. That's one of the things where we come in and work. It's a partnership. There's 28 retirement periods beginning in 1926. 4% worked most of the time. So again, is that relevant today? We don't think as much so. So unfortunately, the environment is much more, if you will, filled with some places where you can step in a hole and break your ankle than it was. How do you get steady, reoccurring income? How do you make sure you don't run out of money? Again, we come back to comfort, clarity, and confidence, things that are very important during retirement. And again, if you'll work through your individual situation with the equivalent of what we call our Live Well plan, you'll be much better prepared to face retirement.
So step number 6, we think of how to face these uncertainties we talked about earlier, is producing income with the stock portion of your portfolio. I love this slide here. Looking from 1930 to the end of 2019, a kind of, for me, it was a startling fact when I first heard it. 42% of the overall return on the stock market came from dividends. And 42%, that's not a rounding error. Almost half of your total return of the stock market over the last, I guess that'd be almost 90 years. That's a big piece. And so we have 15 different investment strategies, one of them being what we call dividend growth. We're looking for companies that not only pay dividends, but have the ability to increase those dividends year over year. And this chart kind of answers the question of why we think that is so important. Dividend growers have grown quicker than dividend payers, quicker than the market, and then obviously quicker than dividend cutters as well. So we think dividends are important whether you're working or not, but even more so for those that are entering retirement and going to need income on a reoccurring basis. And then step 7, planning for long-term care. You can see here these numbers are a few years dated, and numbers are only slightly higher than where they were here. Almost $100,000 a year for nursing home, assisted living, $45,000. Planning matters, and we think just having this a part of your plan is a big deal. We have some clients who like to lay off that risk to an insurance company. Had a conversation the other week with a client where we actually updated his plan. He's having to take his mother-in-law, and he's going to be footing the bill for that. So it can be extended family members paying for their assisted living, nursing home, whatever it might be. But a big ticket item in retirement. And then our last step 8, consider hiring an advisor. We've talked about at length, emotions matter when investing. Mistakes are a lot more costly the closer you are to retirement. You can make a pretty compelling argument that if you made a mistake when you're in your 20s, 30s, even 40s, it's not going to have as much of an effect as it would when you are on the eve of your retirement. And that's a true statement most of the time. Having access to alternative investments, if that is appropriate for you, looking at individual bonds opposed to just funds, and like we talked about, the average investor has underperformed. So we think there is a value add, and the big piece of that is the planning portion of it. The planning portion being specifically our Live Well plan.
So what is the price group process? Number one, we think you need more than just an investment guy. Benjamin Graham, who was a mentor of that guy named Warren Buffett, said, read along with me, the best way to measure your investment success is not by whether you're beating the market, but whether you put in place a plan and a behavioral discipline, you're likely to get where you want to go. So we call it holistic financial planning, income tax planning, retirement, investments, insurance, cash flow, estate planning, goals and objectives. Again, much more than just an investment person, or he's my bond guy or he's my stock guy. A lot of people still will like trading some stocks for fun, but again, we think it should be a fun and not just what we call the meat and potato pot. So anyway, what should a retirement plan look like? Retirement is an ongoing process, not just an event. If your plan is not written down, it is not meaningful. The retirement roadmap that we talk about, we call it our Live Well plan. We'll talk about how much can you spend during retirement. Key thing, how long will your money last? What rate of return do you need during retirement? We spend a lot of time on that. And how do you invest your portfolio for increasing income, inflation protection, and also the preservation of principal. So all important things as you get close to retirement and start saying, I'm not sure that I have a plan, or I'm not sure I have as good a plan as I would like to have.
And then from there, what we do is we help you develop what we call our family index number. What rate of return do you need to get there with the least amount of risk? And so our goal with this is to average this rate of return over a long period of time. Some years will outperform that number. Some years will underperform that number. We might actually have a year where we're right on that number. But that's how we help clients understand and quantify what rate of return are they looking for over that market cycle. You know, it's probably no surprise to anyone. The market has moved higher, like we mentioned, in the bull market that started in 2009. But at some point, we probably have a prolonged down period. And so those good times, those bad times, those sideways times, they average out over a long period of time. But like we mentioned earlier, retirement is more about managing risk than necessarily returns. Returns are important, don't get us wrong, but we think managing risk is actually the key thing to pay attention to.
So what do you need in an investment process? How much can I spend during retirement? How do I invest? We talked about, unfortunately, historically, many investors do not make the best decisions when they're stressed. And so discipline is important. We're a co-partner with our clients. We talk with them, make sure that they don't make decisions that are not in their best interest. And income generation, as Matt talked about, we're big believers in dividend-paying stocks, blue chip stocks that not only pay dividends, but increase their dividends year after year to get inflation protection. Our goal is to preserve your assets and generate the increasing level of income you need to meet the day-to-day expenses and, again, as we say, get there from here. So, again, we call that our Live Well plan. We're happy to do a Zoom meeting on a complimentary basis with you. We take some input. Again, spend time crunching some of the numbers, make some conservative assumptions, and come back to you with a well thought out plan. And then you have the ability to actually change that plan and play a what if analysis with that. So perhaps you've never hired an advisor. Perhaps you've heard some horror stories about some people having bad experience or whatever. That's where we think doing your homework, you want someone that is a fiduciary. Does an advisor represent you, or if they work for a bank or brokerage firm? Again, they're representing that. They're not a fiduciary. Do they have a transparent cost structure? Do they have experience? We talked about if you need heart surgery, you don't want someone that does hearts on Tuesdays, gallbladders on Wednesdays, and knees and big toes on Thursday. You want someone that does hearts from early in the morning to late at night. And the gold standard is being a certified financial planner and also a certified investment management analyst. Our team has, again, many years experience with a succession plan. We have 3 team members that support us, help us keep our promises and make sure that we're doing the things we need to do for each of our clients on their planning. 90% of our clients are retired or approaching retirement. If you're going to build a log cabin, you don't want to go to someone that specializes in building, a modern house, vice versa. So you matter. Our Live Well plans are personalized. It's not a cookie cutter approach on the planning nor the investment strategy. We have a low client to advisor ratio, and we think we communicate well from a standpoint of our weekly email, which you have an opportunity to sign up for, our monthly statements, our webcast, some of the podcasts that we do, or just articles of interest that we send out on a regular basis. And with regards to that, please email us to request our complimentary guide, 10 questions you should ask your financial advisor. So that's the team right there. Maddie, Tiffany, and then Melissa on the far right. Please feel free to reach out with us on any questions or comments. It's our name, Randy.Price, Matt.Price at Steward Partners, Steward with a D, no space in between. We are indeed the Price Group. We are very much of high conviction that everyone does need a wealth coach, and we'd be honored to visit with you again on a complimentary basis. If it's right, we're both going to know it, and we could proceed from there. If not, we'll shake hands, part as friends. And again, our goal, you leave as a more educated investor. And again, you've got a contact, a team that if something comes up in the meantime and you need some more help. So with that, unless we have some questions, Matthew, I think the trains have run on time, and we'll get everybody out and enjoy the rest of the afternoon.